Silver just hit $96 an ounce. The headlines are screaming all-time high. Financial media is calling it a bubble. Your neighbor thinks you missed the boat. But here's the truth nobody wants to tell you. At $96, silver isn't expensive. It's still criminally cheap. In fact, if silver had simply kept pace with the money printer, if it held the same slice of the money pie it had in 1980, it would be trading at $585 an ounce right now. You read that right. Not 96. 585. We're not talking about speculation. We're talking about math. Cold, hard, undeniable monetary math. So if you want to understand why your savings feel worthless, why everything costs more but your paycheck buys less, and why the system is terrified of what happens when people realize silver isn't rising, the dollar is dying, then you need to stay until the end, because what you're about to discover will change how you see money forever. Part 1. The crime scene. How the M2 illusion was created. Let me tell you about the biggest theft in human history. And no, it didn't happen in a bank vault. It happened in broad daylight with spreadsheets and policy meetings and words like quantitative easing that sound boring enough to make you fall asleep. But this theft didn't just rob you once. It robs you every single day. And the weapon? It's called the M2 illusion. Here's what that means in plain English. When you hear that silver hit an all-time high of $96, your brain does something automatic. It thinks, wow, that's the highest it's ever been. Must be expensive. Must be a bubble. Time to sell or stay away. But that reaction is based on a lie. A lie so big, so embedded in how we talk about money, that most people never even question it. The lie is this, that a dollar today is the same as a dollar in 1980. That $96 now means the same thing as $50 back then. That all-time high actually means something without asking a very simple follow-up question. High compared to what? Because here's the thing. Money isn't fixed. It's not a ruler that stays the same length. It's more like a balloon that governments keep blowing air into. And the more air they pump in, the less each individual breath of air is worth. That's inflation. But it's not just prices going up. It's the value of the money itself going down. And we can measure this. We can actually track how much money exists in the economy at any given time. That measurement is called M2. It's basically the total supply of dollars floating around in the system. Cash, checking accounts, savings accounts, money market funds, all of it added together. In 1980, the total M2 money supply in the United States was around $1.6 trillion. That's it. 1.6 trillion. Now fast forward to late 2025, the M2 money supply hit $22.32 trillion. Let me say that again, from 1.6 trillion to 22.32 trillion. That's not a typo. That's not a rounding error. That's a 14-fold increase in the amount of money sloshing around the system. 14 times more dollars chasing roughly the same amount of goods, services, and yes, silver. Now here's where it gets interesting. In 1980, silver hit a peak price of about $50 per ounce. Everyone remembers that. They call it the Hunt Brothers bubble. They say it was speculation, a mania, a one-time event that could never happen again. But what they don't tell you is this, that $50 price wasn't just a number. It was a percentage, a slice of the total money pie. When silver was $50 and M2 was 1.6 trillion, silver represented a specific, measurable weight in the monetary system. It had purchasing power. It had gravity. It mattered. But today, even at $96, silver represents far less of the money supply than it did back then. Because the denominator, the total pile of money, exploded. The pie got 14 times bigger, but silver's slice barely moved. So when people celebrate today's all-time high, what they're really celebrating is a nominal number that has no connection to monetary reality. It's like saying you're richer because your salary went from $50,000 to $96,000. But forgetting to mention that a gallon of milk now costs $40. This is the M2 illusion. It's the gap between what the price says and what the price means. It's the difference between a number on a screen and actual purchasing power. And it's the reason why, even at $96, silver isn't expensive. It's still on sale. Because here's the kicker. The theft isn't that silver went down. The theft is that money went up in quantity, not quality. The government didn't steal your silver. They stole the measuring stick. They debased the ruler. They made every dollar worth less so they could print more of them and pay their bills without raising taxes or cutting spending. And the result? You got poorer. Not because you spent recklessly, not because you made bad choices, but because the unit you save in, earn in, and measure your wealth in was quietly, systematically destroyed. Silver didn't fail you. The dollar did. And the beautiful thing about silver, the thing that terrifies central banks and finance ministries around the world, is that silver doesn't forget. It doesn't play along. It doesn't pretend that a debased currency still has value. Silver just sits there patient, honest, waiting for the math to catch up. And right now, the math is catching up fast. Part 2. The False Recovery, Why Today's Price is Still a Discount. Okay, so if the M2 money supply is 14 times bigger than it was in 1980, and silver hit $50 back then, what should silver cost today to have the same purchasing power? Glad you asked. Because this is where it stops being theory and starts being math. Cold, brutal, undeniable math. If you take silver's 1980 peak of roughly $50 per ounce and adjust it for the M2 expansion, you get a number that most people aren't ready to hear. That number is somewhere between $585 and $600 per ounce, not 96, not 120, 585 to 600. That's not a prediction. That's not a price target. That's parity. That's what silver would need to trade at today just to have the same monetary weight it had in 1980, just to break even in real terms. Let that sink in for a second. The media is out here calling $96 a record high and a bubble, but in reality, silver is still trading at roughly 1/6 of its 1980 purchasing power. It's down 83% in real terms. 83%. Imagine if your paycheck was down 83%, but your boss kept telling you that you got a raise because the number on your paycheck looked bigger. You'd call that gaslighting, you'd call that fraud. But when it happens to an entire monetary system, we call it economics. This is the false recovery. This is the illusion that makes people think they missed the move when in reality, the move hasn't even started yet. And here's why this matters to you even if you don't own a single ounce of silver. Because this same dynamic applies to everything. Your wages, your savings, your home, your retirement account. Everything denominated in dollars is being measured against a yardstick that keeps shrinking. So when your salary goes up 3%, but your cost of living goes up 8%, you're not falling behind because you're lazy. You're falling behind because the money is broken, and the people in charge know this. They have to. They have access to the same data we do. They know that M2 exploded. They know that real purchasing power collapsed. They know that calling $96 an all-time high is technically true but functionally meaningless. But they keep saying it anyway. Because if people understood what really happened, if they understood that their wealth was systematically transferred to the people closest to the money printer, there'd be riots, there'd be revolutions, there'd be a loss of faith in the entire system. So instead they celebrate the recovery. They point to stock market highs and real estate booms and say, see, the economy's great. But they don't mention that those highs are measured in a currency that lost most of its value. They don't mention that you're running faster just to stay in place. And silver is the mirror they don't want you to look into. Because silver reflects the truth. It shows you what money used to be worth. It shows you what you lost. And more importantly, it shows you what you could still reclaim. Here's the thing. If silver is 6 times undervalued relative to its 1980 purchasing power, that means there's still 600% upside just to get back to parity. Not to the moon, not to some speculative mania, just to break even in real terms. But the system doesn't want you to know that. Because if everyone rushed to trade their devaluing dollars for undervalued silver, the illusion would collapse overnight. The game would be over, and the people holding trillions in paper wealth would wake up to find out it was never real. So they call it a bubble. They call it speculation. They call it risky. They do everything they can to keep you focused on the nominal price instead of the monetary math. But the math doesn't care what they call it. The math is the math. And right now, the math says silver at $96 isn't expensive. It's still a screaming buy. Because here's the reality, silver isn't rising. The dollar is falling. And every day that gap gets wider, the illusion gets thinner. Eventually the market wakes up. Eventually the nominal price catches up to the monetary reality. And when it does, $96 is going to look like the deal of the century. But we're not done yet. Because price manipulation and monetary distortion can only last as long as there's enough physical silver to go around. And that's where the story gets really interesting. Because the paper game is one thing. But the physical reality, that's starting to break. Part 3. The physical break, when paper silver meets reality. Let me explain how the silver market actually works, because once you understand the mechanics, you'll see why the whole thing is about to snap like a rubber band stretched too far. For decades, silver traded mostly on paper, futures contracts, derivatives, ETFs. Basically, promises of silver, IOUs. People bought and sold silver without ever touching it, holding it, or even confirming it existed. It was all virtual, all abstract, and as long as nobody asked for delivery, the system worked fine. But something changed, and it started about 6 years ago. Since 2020, the silver market has been in a structural deficit. That means every single year the world uses more silver than it produces. Mines aren't keeping up. Recycling isn't covering the gap. And demand, especially industrial demand, just keeps growing. Solar panels, electric vehicles, 5G infrastructure, medical devices, electronics. Silver isn't just a shiny metal anymore. It's a critical industrial input. And unlike gold, which mostly just sits in vaults, silver gets used up, consumed, destroyed in tiny amounts across 1 million different products. And here's the kicker. You can't just make more of it. About 71 to 75% of all silver that gets mined doesn't come from silver mines. It comes as a byproduct of mining other metals, lead, zinc, copper, gold. That means when you dig for copper and happen to find some silver along the way, great. But you can't just turn on more silver production when the price goes up. You'd have to turn on more copper mines, more lead mines, more zinc mines, and that takes years, permits, infrastructure, billions in capital. So even though silver is pushing toward $100 an ounce, supply is still inelastic. Miners can't react fast enough. The metal just isn't there. And now we're in year 6 of the deficit. 6 straight years of using more than we produce. And the result? Inventories are collapsing. Let's talk about COMEX for a second. That's the big commodity exchange in the US, where a lot of silver trading happens. They have 2 categories of inventory, eligible and registered. Eligible means silver is sitting in the warehouse, but not available for immediate delivery. Registered means it's ready to go. Someone can buy a contract and actually take the metal home. Since 2020, COMEX registered silver inventories have dropped by over 70%. 70%. We're talking about a massive drawdown. And as of right now, there's only about 123 million ounces of registered silver left in COMEX vaults. That might sound like a lot. But let me put it in perspective. The world uses about 1 billion ounces of silver per year. So 123 million ounces, that's about 45 days of global demand. A month and a half. That's it. Now, COMEX isn't the only place silver is stored, but it's one of the biggest. And it's the benchmark. It's where price gets set. So when registered inventories collapse like this, it sends a message. The physical metal is disappearing. And 2026. This is the year it could all come to a head. The projected deficit for 2026 is at least 30.5 million ounces. That's the baseline estimate, but some analysts think it could be way worse, closer to 200 million ounces. Why? Because of export restrictions, because of new industrial demand, because of countries and companies hoarding physical metal instead of trusting paper promises. And here's the thing, once the physical break happens, the paper game is over. Because you can manipulate price on a screen all day long. You can naked short, you can roll contracts, you can play accounting tricks, but you can't print physical silver. When someone shows up with a futures contract and says, "I want delivery," and the warehouse says, "Sorry, we don't have it," that's game over. That's when trust collapses. That's when price explodes to whatever level it takes to find real metal. We've seen this before in other commodities, nickel in 2022, palladium a few years before that. Markets that looked stable on paper until someone asked for delivery, and suddenly the whole structure fell apart. Silver is heading that direction, and the people running the show know it. They're just hoping they can keep the plate spinning long enough to get out before it all crashes down. But physics doesn't care about hope, and right now, the physics of supply and demand are screaming one thing: there isn't enough metal. The illusion worked as long as silver was abundant, but abundance is over, scarcity is here, and scarcity has a way of turning illusions into dust. Now, if this was just about supply and demand, it would be bad enough. But it's not, because in 2026, geopolitics just threw gasoline on the fire. Part 4. The geopolitical shock when supply becomes a weapon. Okay, so we've got monetary debasement, we've got structural deficits, we've got collapsing inventories. That alone would be enough to send silver through the roof. But in early 2026, the world decided to make things way more interesting. Let's start with the tariffs. In January of 2026, President Trump threatened to slap tariffs, anywhere from 10 to 25%, on European nations over a dispute involving Greenland. Now you might be wondering what Greenland has to do with silver, and the answer is nothing directly. But here's what matters. When the US president threatens trade wars with Europe, global markets freak out. Investors run for safety, and where do they run? Gold, silver, hard assets. Stuff that can't be printed, devalued, or inflated away. That tariff threat triggered a massive safe haven rush, and on January 22nd, 2026, literally yesterday, silver hit $96.45 per ounce, a new all-time nominal high. The headlines went crazy. The financial media said it was a bubble, but anyone paying attention knew the truth. This wasn't speculation. This was fear. Fear that the global trade system is breaking. Fear that currencies are losing value. Fear that the only safe place left is hard assets. But the tariffs were just the warm-up act. The real shock came from China. On January 1st, 2026, China rolled out a new licensing framework for silver exports. And this wasn't some minor policy tweak. This was a strategic choke point. Because here's the thing. China controls 60 to 70% of the world's refined silver supply. Let me say that again. 60 to 70%. Most people don't realize this, but China isn't just a big player in silver. They are the player. They refine more silver than anyone else on the planet. And now, if you want to buy refined silver from China, you need a license. And getting that license? Good luck. This is what we call export weaponization. China looked at the global silver market and said, you know what? We need this metal for our solar industry, for our electronics, for our infrastructure. So we're going to make it really hard for you to get it. And just like that, the global silver supply got cut by more than half, overnight. Now you might think, okay, but can't other countries just refine their own silver? And the answer is, eventually yes. But refining capacity takes time to build. You can't just flip a switch. You need facilities, equipment, expertise, permits, years. So in the short term, the world is stuck. Industrial buyers, companies that need silver to make products, are scrambling. They're bidding up prices. They're securing multi-year contracts. They're hoarding inventory, because if they can't get silver, their entire production line shuts down. And this isn't just about some niche luxury product. We're talking about solar panels, electric cars, medical equipment, consumer electronics, stuff that modern civilization depends on. Silver just went from shiny investment metal to strategic industrial choke point. And that changes everything, because now it's not just investors buying silver, it's governments, corporations, countries trying to secure supply chains before it's too late. And when that happens, price stops being about speculation and starts being about survival. But wait, there's more. Let's zoom out for a second and talk about the bigger picture, because the Greenland tariffs and the China export restrictions didn't happen in a vacuum. They happened against the backdrop of a US fiscal crisis that's spiraling out of control. The US government is projected to run a deficit of about $1 trillion in fiscal 2026. The national debt is approaching $50 trillion. $50 trillion. That's not a number you can tax your way out of. That's not a number you can grow your way out of. That's a number you inflate your way out of. And that's exactly what's happening. The money printer is running hot. Deficits are being monetized. And every time the Fed creates another $1 trillion to buy treasury bonds, the value of every existing dollar goes down a little bit more. Investors see this. They're not stupid. They know that holding cash is a losing game. They know that bonds are a trap. They know that the only way to preserve wealth in this environment is to own real things, tangible things, things that can't be printed or debased. And that's where silver comes in. Silver isn't just a commodity anymore. It's a monetary lifeboat. It's a vote of no confidence in the system. It's a way to say, I don't trust your paper. I don't trust your promises. I want something real. And when you combine that sentiment with physical shortages and export restrictions, you get a perfect storm. A storm that doesn't care about analyst forecasts or government reassurances or media narratives. The geopolitical shock of 2026 didn't create the silver bull market. It just lit the fuse, and now the bomb is ticking. But if you want to know when that bomb goes off, you need to understand one more thing, one more signal that everyone in the know is watching, and that signal is the gold to silver ratio. Part 5. Ratio collapse, the silent signal. Everyone missed. All right, let's talk about a number that most people have never heard of, but that traders and investors obsess over. It's called the gold to silver ratio, and it's one of the most reliable signals in the entire commodities market. Here's how it works. You take the price of gold and divide it by the price of silver. That gives you a ratio. So if gold is trading at $2,000 and silver is trading at $20, the ratio is 100 to 1, meaning it takes 100 ounces of silver to buy 1 ounce of gold. Now historically, that ratio averages somewhere between 50 to 1 and 70 to 1. That's the normal range. When the ratio is in that zone, gold and silver are moving in sync. The market is balanced, everything's chill. But when the ratio gets way out of whack, like above 80 or 90 or 100, it means silver is cheap relative to gold. And historically, when that happens, silver catches up. Hard, fast, violently, and that's exactly what we saw in 2025. In 2025, the gold to silver ratio hit 100 to 1. That's extreme. That's a screaming signal that silver was undervalued compared to gold. And what happened? Gold went up 67% in 2025. Not bad, right? But silver? Silver surged 147%. It more than doubled gold's returns, because the ratio compressed, because silver caught up. And as of today, January 22nd, 2026, the ratio is sitting at about 51 to 1. It went from 100 to 1 to 51 to 1 in just over a year. That's a massive, violent correction, and it's one of the clearest signals that silver is in the middle of a historic repricing. Here's why this matters. The gold to silver ratio doesn't lie. It's not based on headlines or hype or sentiment. It's based on pure mathematics, and when that ratio is stretched, the market has a way of snapping it back into place. But here's the thing. 51 to 1 is closer to normal, but we're not done yet. Because if silver is still 6 times undervalued in M2 adjusted terms, and if the physical deficit keeps getting worse, and if geopolitical chaos keeps escalating, there's no reason the ratio can't compress even further. In past silver bull markets, the ratio has gone below 20 to 1, below 15 to 1. Hell, in 1980, it briefly touched single digits. When silver goes parabolic, it doesn't just catch up to gold, it obliterates it. And we're starting to see the early signs of that now. Think about it. Gold gained 67% in 2025. That's a monster year for gold. But silver gained 147%. That's not just outperformance. That's a different asset class entirely. And the reason is simple. Silver is smaller, is more volatile. It has more industrial demand. And when money starts flooding into precious metals, silver gets the leverage. It gets the momentum. It gets the explosive moves. Gold is the safe, boring older brother. Silver is the wild younger sibling that either crashes your car or makes you a millionaire. And right now, silver is in full send mode. But the ratio collapse isn't just about traders making money. It's a signal of something deeper. It's a signal that the market is waking up to the monetary reality we talked about earlier. It's a signal that the M2 illusion is breaking. It's a signal that people are starting to realize that paper promises aren't worth the paper they're printed on. Because here's the truth. Gold and silver aren't going up. The dollar is going down. And the ratio compression is just the market's way of saying, yeah, we figured it out. We know the money's broken. And we're getting out. Now, you might be thinking, okay, this all sounds great for silver investors, but what does this mean for regular people? People who don't own silver? People who are just trying to pay their bills and feed their families? Great question. Because this isn't just an investment story. This is a human story. And the human cost of the M2 illusion is about to hit home in ways most people aren't ready for. Part 6. The human cost. When the illusion finally dies. Let's get real for a second. Because this isn't just about charts and ratios and monetary theory. This is about your life, your family, your ability to survive in a system that's rigged against you. Here's what the M2 illusion actually means in human terms. It means your paycheck buys less every year. It means your savings lose value while you sleep. It means the retirement you planned for is slipping further and further out of reach. It means your kids are going to inherit a world where housing costs 10 times what it should, where education is unaffordable, and where a middle-class life feels like a fantasy. This isn't an accident. This is the direct result of currency debasement. This is what happens when governments print money to pay their bills instead of making hard choices. They don't raise your taxes directly. That would be too obvious, too painful, too likely to spark revolt. Instead, they just create more dollars and let inflation do the dirty work. And the result? You get poorer, quietly, gradually, invisibly. But silver? Silver doesn't play that game. Silver is honest. It holds value. It reflects reality. And when the currency collapses, silver is the thing that people run to. Not because it's magical, but because it's real. Now let's talk about the industrial side. Because the silver shortage isn't just a problem for investors. It's a problem for everyone. Silver is in everything. Solar panels that are supposed to save the planet need silver. Electric cars that are supposed to replace gas guzzlers need silver. Medical devices that save lives need silver. Your phone, your computer, your TV, all of them use silver in tiny amounts. And when silver becomes scarce, when China restricts exports, when inventories collapse, guess what happens? Prices for all of those products go up. Production slows down. Companies can't get the materials they need. Supply chains break. You thought the chip shortage was bad? Wait until the silver shortage really kicks in. Because unlike chips, you can't just build another factory and solve the problem. Silver is mined, it's finite, and we're running out. So when people talk about the energy transition or the green economy, they're talking about a future that requires massive amounts of silver. But nobody's talking about where that silver is going to come from, because it doesn't exist. Not in the quantities we need. And that's the cruel irony. The same policies that created the M2 illusion, the money printing, the deficit spending, the fiscal insanity, are the same policies funding the industrial demand that's driving the silver shortage. It's a feedback loop, a death spiral. And the people at the bottom, the workers, the families, the regular folks just trying to get by, they're the ones who pay the price. But here's the thing. Silver isn't the problem. Silver is the solution. Because silver forces the system to tell the truth. When silver prices explode, it's not because silver is getting more valuable. It's because the currency is getting less valuable. Silver is just the mirror. It reflects the rot. It shows you what the government doesn't want you to see. And when the illusion finally dies, when people wake up and realize that their dollars are worth a fraction of what they used to be, there's going to be chaos. There's going to be panic. There's going to be a scramble for anything real, anything tangible, anything that holds value. But here's the good news. You don't have to wait for the collapse. You don't have to be a victim. You can protect yourself now. You can trade your depreciating dollars for appreciating assets. You can reclaim the purchasing power that was stolen from you. Because that's what this whole story is really about. It's not about getting rich. It's about not getting robbed. It's about preserving what you've earned. It's about making sure that when the dust settles, you still have something left. Silver isn't rising, the dollar is dying, and the people who understand that, who act on it, are the ones who survive. Now, let me be clear. I'm not saying silver is going to save the world. I'm not saying it's a magic bullet. I'm saying it's a lifeboat. And when the ship is sinking, you want to be in the lifeboat. The M2 illusion is evaporating. The physical shortages are real. The geopolitical chaos is accelerating. The ratio is compressing, and the human cost is mounting. The question isn't whether the system is broken. The question is, what are you going to do about it? Because here's the truth they don't want you to know. The purchasing power wasn't lost, it was stolen. And it's sitting right there, waiting for you to reclaim it. All you have to do is trade the lie for the truth. Trade the paper for the metal, trade the illusion for reality. Silver isn't rising, it's revealing. And what it's revealing is the biggest con in human history. The only question left is, are you going to keep playing their game, or are you going to opt out while you still can? Because the clock is ticking, the inventories are draining, the deficits are exploding, and the illusion is fading fast. Silver at $96 isn't expensive, it's still cheap. And if you understand what we just covered, the M2 math, the physical break, the geopolitical shock, the ratio collapse, you know exactly why. The crime scene is clear, the evidence is undeniable, and the verdict is in. Your purchasing power was stolen, but it's not gone. It's just waiting for you to take it back.